Curious how recent interest rate cuts could impact your investments? Welcome to our channel, where we merge insightful financial discussions with actionable strategies.
Today we'll explore how these interest rate adjustments are influencing markets like the S&P 500 and Bitcoin.
We'll hear from industry experts like Jeff Snider and Bradley Tusk, offering key insights and strategies you won't want to miss.
Stay tuned as we dive into shifts in consumer behavior due to these economic changes.
Our mission is to distill complex analyses into simple strategies for you.
Join us as we uncover major market trends and crucial warnings from top economists.
So, are we gearing up for a storm or rally in the markets? Let's find out.
Want to know whether to brace for a storm or welcome a rally? Let's find out.
Let's begin our analysis today with Jeff Snider from Eurodollar University.
We'll examine the impact of interest rate cuts on the global economy and market responses.
So what's the essence of Snider's discussion on interest rate cuts?
He suggests these cuts reveal central banks are acting out of necessity, suggesting deeper systemic issues in commerce.
How are global markets responding to these cuts?
The reaction has been swift, with volatile swings as investors sift through uncertainty. These fluctuations indicate a lack of confidence in sustained recovery.
What about consumer spending? Is it on the rise?
While lower rates usually encourage spending, ongoing uncertainties have led consumers to hold back on larger purchases.
Interesting dynamics at play. What changes are we seeing in investment strategies?
Investors are now recalibrating their portfolios due to low-interest environments. Risk assessment has become paramount in these shifting landscapes.
Looking forward, what does Snider predict for the future of interest rates?
He forecasts further adjustments are likely as central banks respond to continuous economic shifts, hinting at deeper systemic issues.
What about the long-term investment landscape?
Snider warns that sustained low rates could compel investors to adopt more cautious and innovative strategies to anticipate minimal growth.
In conclusion, what are the major takeaways from today's discussion?
Snider emphasizes the broader implications of interest rate changes, far beyond consumer habits and into long-standing investment strategies. The maze of market responses requires careful navigation.
Now that you're in the loop, what strategies will you adopt in response to these changes? We want to know.
Share your strategies in the comments. Let's collaborate and tackle this evolving financial landscape together.
Next, we dive into Bradley Tusk's insights on the Federal Reserve's anticipated pivot and its implications for the tech sector.
Prepare for a comprehensive overview of how interest rates could reshape tech investments.
Let's distill the main thesis here. Why is the Fed's pivot significant?
Tusk argues that lower rates could provide cheaper capital for tech investments, igniting potential growth, but warns of looming economic pressures.
What's the current landscape for early-stage technology?
Tusk claims a liquidity crunch is hampering venture capital as funding rounds slow down and fewer startups go public.
What role does AI play in this environment?
Tusk expresses caution. Many investors are banking on uncertain revenue streams associated with AI, which could lead to speculative bubbles.
And what about potential Fed actions?
A rate cut from the Fed could enhance capital access for tech firms, revitalizing stalling investments amid high costs.
What about investment risks?
Tusk highlights concerns over dependence on major players like Nvidia, suggesting their high valuations don't guarantee lasting growth.
What's Tusk's prediction for upcoming tech IPOs?
He anticipates a surge in tech IPOs if the market stabilizes, hinting at further regulatory impacts on valuations.
What trends should investors be alert to?
Tusk foresees an uptick in IPOs as market conditions improve, possibly igniting recovery.
What does Tusk say about valuation corrections?
He warns that overvalued tech stocks may face inevitable corrections as actual financial metrics come to light.
In closing, how should we view the tech landscape?
Tusk emphasizes a balanced perspective. While rate cuts present opportunities, investors must remain vigilant against speculative pitfalls.
And how important is continuous monitoring?
Absolutely vital. Understanding market dynamics and regulatory changes will be key to navigating the shifting tides ahead.
What final thoughts should we leave viewers with?
Engagement is crucial. We want to hear your predictions. What trends do you believe will shape the future of tech?
Shifting perspectives, let's discuss the significance of Central Bank Week.
As the FOMC rate decision approaches, what potential outcomes could affect traders across the board?
What's the core thesis of this week's central bank discussions?
The upcoming FOMC decision is poised to impact market stability significantly, with traders anticipating either a 25 or 50 basis point cut.
What key indicators should we monitor?
Market reactions as we near the FOMC announcement are crucial. Historically, markets show significant volatility before and after such decisions.
What additional insights did analysts provide?
The analysis revealed that many traders might hedge their bets, showcasing common strategies in uncertain times.
How will this affect various sectors?
Should rates fluctuate, it's vital for investors to adjust strategies, especially regarding utilities and consumer goods, contrasting with tech stocks.
What predictions are emerging regarding market reactions?
Analysts anticipate that extreme fluctuations are likely regardless of the FOMC outcome, urging investors to remain adaptable.
What may the larger implications mean?
The FOMC decision could signal the Fed's assessment of economic health and its strategies to contain inflation. Understanding these nuances is crucial.
What should traders remember from this week's discussions?
It's essential to remain prepared for possible volatility following the FOMC decision. Staying informed and responsive is key.
What's the final takeaway for our viewers?
Understanding the Fed's logic behind their actions will be crucial not just this week, but for ongoing trading strategies. Your insights into market psychology will be your strongest asset.
If you enjoyed these insights and want to stay ahead in trading, don't forget to like and subscribe.
Subscribing keeps you updated with the latest financial summaries, ensuring you don't miss out on critical market discussions and predictions. Let's keep this momentum going.
Let's regroup and analyze Meb Faber's insights on investment strategies in this changing market landscape.
Faber dives into consumer sentiment trends and shares actionable tactics for navigating uncertainty.
What's the key takeaway from Meb Faber's analysis?
Faber stresses a cautious approach. While consumer sentiment seems to rise, challenges like a struggling housing market loom.
Let's examine the housing market further. What's currently affecting it?
Home sales have dropped sharply to levels not seen since 2012 due to rising mortgage rates above 6%, leaving buyers unsettled.
And how's the Fed responding?
Faber notes mixed market expectations, where potential rate cuts could stimulate significant changes in stocks and bonds.
What investment opportunities has Meb identified?
Meb sees more promise in global REITs compared to domestic ones. Factoring in quality and shareholder yields may provide footing in this volatile market.
What predictions does Meb foresee?
He predicts a continued decline in interest rates, possibly reconfiguring traditional asset class dynamics, offering opportunities for some investors.
Is gold projected to rise?
Faber maintains a bullish outlook for gold, anticipating it to reach all-time highs as more investors take note.
So, what should investors carry forward?
In summary, Meb advises remaining diverse and cautious in investment strategies, as the years ahead could be pivotal for those prepared.
To wrap up our analyses, we'll discuss the implications of the Fed's impending rate cut.
Jason Shapiro breaks down key insights about the upcoming Fed meeting.
What's the essence of Shapiro's analysis?
He argues that while the rate cut is highly anticipated, the focus should be on broader market reactions rather than the specifics.
What's the primary takeaway surrounding the Fed's rate cuts?
Shapiro highlights the unpredictability of market movements following rate cuts, urging caution in interpretation.
What signals are we watching for?
The impact of emerging liquidity trends and how they could influence gold prices, as well as how these aspects intertwine with inflation.
What trading strategies does Shapiro recommend?
He emphasizes assessing market reactions post-Fed announcement as crucial for gauging future movements.
What's the key trading strategy Jason emphasizes?
Instead of trying to predict the Fed's moves, he advises focusing on how the market responds. It's all about the market's mood, folks.
What does Shapiro think about gold's performance?
He urges attention to how gold, as a liquidity proxy, reacts to the rate cut, as any lackluster performance may signal trouble.
What should be our key focus in the coming periods?
Ultimately, maintain an astute awareness of market liquidity dynamics and build strategies aligned with prevailing economic signals.
To sum up, Shapiro's insights suggest a need to prioritize market reactions over speculated Fed actions.
So as the Fed makes its move, remember to keep your eyes on market behaviors and adapt your strategies accordingly.
How about the implications for liquidity?
Monitoring liquidity trends will be key in identifying upcoming market shifts. A fascinating journey lies ahead.
Finally, we want to hear what you think. How will the market react to the Fed's decisions?
Let us know your predictions in the comments below. It's your chance to share your insights on these market waters.
We've reached the end of our analysis today, where we've unveiled diverse insights from our esteemed guests.
Absolutely. Our experts agree that interest rate cuts are sending very clear signals about the economic landscape.
While Jeff Snider raised concerns about unresolved issues, Bradley Tusk remains hopeful about a tech bounce.
And then we have Meb Faber, who thinks investing at highs in gold and stocks could still prove beneficial.
These guest perspectives highlight the mixed signals we face in today's market. It's exciting, yet filled with uncertainty.
If you found these insights valuable, don't forget to hit that like button and subscribe to stay updated.
Check out our other videos where we continue to delve into market trends and expert opinions.
Thanks for watching, and until next time, keep navigating the financial landscape with confidence.